I now wanted to talk to you about impairment of financial assets. So that's again what is called as expected credit loss model. And let me give you a very simple example of expected credit loss model. What does it mean, right? Now today, the current practice of providing for doubtful debt was incurred credit loss model, right? And incurred credit loss, let's say you've given 100 rupees to a friend, right? And your friend is actually and the friend made a promise that I'm going to repay you after 6 months, okay? And then you believe that this guy is good, this guy will pay me back, but at the end of the 6 months you realize that this guy is not going to pay you, right? The money is going back, and the existing accounting was this money is bad, you got to provide for this, which is called incurred credit loss model, that the money is now bad, you provide for 100 rupees as provision for bad debt. Now the expected credit loss model, what it expects that the moment you are extending credit to a counterparty, there is a credit risk, and if there is a credit risk, there is going to be a default on all your arrangements. So it is like saying that now if you simply extend the same example that I've given money to 100 friends, okay, 100 rupees to 100 of my friends, now you know that 98 of them may return money, 2 of them will not return money, right? And that's the risk which you are trying to take, right? And you know that when you are extending credit, that there is a risk that the money is not going to come back. That's the fundamental principle of risk management, that there is a credit risk and there is a risk of default, and hence the money may not come back. What the expected credit loss method expects you to do is that you start building in the reserve on day 0 itself. The moment you extend credit, you build a model that how much of this can potentially go bad, and you start providing for this. And that's what is called as it can be a general approach or a simplified approach. There are multiple methods which are provided for in the standard. And again, the key for you to understand is that you got to start building in the reserve the moment you are exposed to a credit risk, and then there are methodology which is out there for you to start building in the reserves around that.